handicap. At the time, I actually made a video about it. That for me, that handicap was too high.
Long-term calculation of like what the EV of this particular spot is, how much are you actually winning for? Is this a fair spot that you're giving Perkins in this particular instance, et cetera, et cetera, et cetera. So I guess like talk a little bit about how easy it is to get swept up whenever it comes to the public attention and it comes to being an influencer or a personality that people are following and engaging with.
And this is kind of what I was trying to say. Like,
it becomes one of those things, at least in my perspective, where it's very easy to overinflate an ego as well as overestimate ability. Where it comes to the attention is nice, and like having that spotlight is something that I never had. So having that was something that was new to me, and it was a feeling that I kind of wanted to chase. But at the same time, I never really had a conversation with anyone from my corner, so to speak, about, oh, hey, like I'm willing to lay 9. Because I knew that win rates in heads up was very high, like upwards of double digits in big blinds, but that's versus someone that doesn't study. And that's in a different player pool, and that's not where there's public attention and media.
The first error was pretty serious, because the poker professional actually underestimated the ability of the recreational player. This specific recreational player is just not any guy. This specific recreational player's professional background was dealing with scenarios where the number of moving parts is much bigger than 52 random pieces of paper. Much bigger. A background, his professional knowledge was very directly, could be applied directly to poker. Directly. The logic, the reasoning, the probabilities, the payouts, all of these were the standard exercise of this person every day. In fact, that's how he made his money, not from poker. In addition to that, this person over here could easily learn the scenario analysis that we saw in the earlier clip. So that was problem number 1. In other words, the difference between the poker professional and the recreational player was smaller than the handicap. That could have been okay, because the fact is that the professional could have made up the difference. That is possible. However, that's when mistake number 2 happened, and this one was serious. In this video, I spoke about it at length. Basically what happened, if one party or the other, if one of the persons or the other person got way ahead, they got to basically start over. And that is something called resetting the stack. What this did is this gave away the exact edge that the poker pro required in order to make up the difference, in order to make up the handicap that he gave to the recreational player. It might seem like this is just a string of criticisms of Landon Tice. It's not. It's actually not at all. Because actually the real takeaway is the fact that he then resigned. And in that, he displayed a wisdom well beyond his years. He's not even spitting distance yet to the age of 30. And this is the point. The point is that he is expert in probability. After he realized that he had wrongly estimated the difference, after he realized the fact that the structure of the game wouldn't allow him to make up this difference, he ultimately resigned in the contest. And while he got criticized by people, the poker community, etc., etc., it's very clear to me what he did. They went to work, they studied the numbers, they realized the structure wasn't in their favor, they cut their losses. In other words, they reconnected with the logic at which they're expert from the beginning, and then realized, oh, this is our spot now. We can't reach our objective. Let's cut our losses. The losses were a sunk cost. There's no reason to try to keep throwing good money after bad. My point here is that people get in this spot regarding financial matters all the time. They miscalculate. They underestimate something. They didn't understand the implications of the structure. You could be an expert in your field. During this video, you may have forgotten more math than I have ever learned throughout my lifetime. Let's not throw away the logic, the knowledge, your experience that you have. Just because the topic is different doesn't mean that the logic, the rationale, the way to think through matters changes. People make mistakes. You're hit with false narratives. There's happy talk everywhere.
In either case, you have to go back to 1980 to find a year where stocks were down double digits and bonds were down worse. There has been no place to hide other than cash. Even a 5-year treasury, you got slaughtered on duration. And in that kind of environment, you have to learn technicals. Like you can't be one of these people that comes on in January, February, March, arguing with me, telling me, oh, this is a great company. Yeah, we all understand that, but the stock is for sale 4 out of 5 days. And then we have these green days where the Dow goes up 800 points, and everybody forgets you're in a downtrend. You're in a bear market in the NASDAQ. You're in a statistical downtrend in the S&P as of right now. We're going to finish this month, as I told you, below the 10-month moving average for the first time in a long time. This is not an environment that's rewarding fundamental happy talk about how great the management is or how innovative the software is. Nobody cares. Stocks are for sale. That's not going to continue indefinitely. And by the way, the money has to go somewhere. So you're not going to have bonds and stocks continue to lose day after day. But you have to understand the environment you're in before you start worrying about, was this a good or bad earnings quarter? Nobody cares.
The financial press is dominated about talk of the numerator. On this simple calculation, in this picture, everyone's focused on the numerator with very, very little attention on the denominator, even though the denominator is far bigger, far more important, influenced by parties much, much, much bigger than anyone who's talking about the numerator. In fact, that was never the reality. It just so happened to be that the new denominator, interest rates, were stable and lower. One-way train for decades.
If you had a good quarter, your stock's down 5%. If you had a neutral quarter, your stock's down 12. And if you had a really bad quarter, you're down 40. That's the environment you're in.
We can change the topic. Life insurance, annuity, dental insurance, portfolio strategy. The same exercise happens over and over. People misunderstand from the beginning. People misunderstand the structure. Brandon Tice did the right thing. He adjusted once he realized he misunderstood. It may seem like I'm offering specific financial advice. I'm not. Instead, the information there on the channel is so that you can use what you have, use your common sense, so you can help cut through the noise and then be able to make a sound financial decision. Now, that's not the same as executing, which is an entirely different thing. For that, there's professional services. But before you even get to that point, it's best to have questions from a sound basis of knowledge so that you can separate the signal from the noise. And there's a lot of noise. There we go. Hi, everybody. You can see technology has improved notably here. Stream should be improved. You got graphics and all this kind of nice kind of thing going on. It's Friday, June 4th, right around noon. Thank you so much for joining. This is Maximize Your Medicare, the newest edition. It's out. If you are a newly paid subscriber to the Substack, I'm going to send you the book anywhere in the lower 48 for free. Please, all you need to do is subscribe on Substack. You can see the link In the text below, oops, it's not actually even here on this text. Let me just put this here. I'll do that in a moment. Anyway, what ended up happening is you can just send me an email to info@gh2benefits.com, and I will then send you the book anywhere in the lower 48 states. If you're not in the age division for Medicare, let's just say you're 45, your parent doesn't understand Medicare, I promise you. I've not done a good job of promoting the book for purposes to help our senior parents, right? Sometimes you don't want to be in their beeswax. I get it. Sometimes, they're still treating you like a child. I get it. Nevertheless, rest assured, I'm very sure that your parents don't understand Medicare. It hasn't mattered who I've talked to. Didn't matter where it was. Didn't matter what the educational background or financial situation of the crowd as a whole. Somebody gets something wrong, and they get it wrong bigly. In other words, the errors in understanding here are enormous. Up on your screen, let's just move on to it. And here's how how important Medicare is and how misunderstood it is, to give you an idea. This is the annual report which Fidelity always seems to produce regarding its projection of what your health care costs would look like for Medicare planning purposes for the future. And you can see a pretty alarming number here, $315,000. Now, the reality is, and I'm going to be saying this with Bob Powell on thestreet.com, is Jay is not overwhelmed with negativity or alarm here. I'm just not. And the reason is that an analogy by my friend Josh Scanlon, he said, no one said you need $315,000 today, right? I mean, you're not, I'm going to spend $1 million, well over $1 million, on food. That doesn't mean I need $1 million in cash today, right? Let's not call it that. What it is about asset and liability matching, et cetera, as if you were at a company, right? You know that you're going to be getting some kind of income, call it Social Security, call it RMD. Maybe you have a pension. If you, depending on, your employer, that is dying out, something that people know. But let's just say you had a defined benefit pension. Well, you're matching how much you owe to the Medicare system with your paycheck that you're getting, right? So this number, 315,000 by itself in isolation, just for me, is not the source of alarm. That's not to say that the misunderstandings, don't exist, right? As you can read down here, and I'll put in a link in the text after we're done with the broadcast, is you can see that over here, you can see that people don't understand what is going on. And that is true, right? You can see that $315,000 healthcare and medical expenses throughout retirement, fine. The issue here is that this number is also, without being able to, what ends up happening is I actually can't see the report. The actual report, the methodology, what is added, what's not added. They do give you some clues here, though, which is enrolled in traditional Medicare, which between Part A and Part B, etc., and Part D. It doesn't talk about whether or not this includes Medigap. Most likely the answer is no here. This number sounds low if you included Medigap. It doesn't include Medicare Advantage. So the thing here is that, you just don't know what is coming up with the 315. Let's just call it one person, $150,000 for men. You're just not certain what this is in here when they're creating this number, which makes you squint a bit. What I do agree with is some of these statements here. So you can see this person from Fidelity says, healthcare costs should remain a top factor when planning for retirement. In fact, crazy people write books about this very thing, which is, since your downside is the most extreme, if you have unexpected or just ongoing healthcare costs that you did not understand, did not anticipate, or you do understand because you lost the DNA coin flip, for example. You have a family history. Bottom line here, as always, is Medicare is that spot where you get access to the highest quality access of financial contracts at the government regulated price, adjusted for taxes, and that's why lots of other videos along those lines that exists. I spoke in Nashville in front of the high end of wealth managers, wealth advisors, right? And basically I rhetorically asked them, not as a challenge, but largely to strike my point, which is that name me any other financial situation where there's no barrier to entry to the best of class of everything. You don't get to go to Rumpelstiltskin Asset Management, right? You need to have X number of dollars in order even to qualify as a client, and then they're going to charge you. Here, information on Medicare, this channel, Maximize Your Medicare channel, this book, free resources. It's just your access to the most important contract at the beginning. And your price to entry is the same as everyone else. I did find one thing alarming, though, in this report. Once respondents of the research were informed of Fidelity's estimate, a staggering 70% of respondents say they feel they are unprepared to cover healthcare costs during retirement. I don't know. 70% unprepared. That doesn't necessarily... No. If this is for pure healthcare costs, meaning going to the doctor, going to the hospital, this sounds too high, first of all. I can pretty much say that financial planning clients, they just don't have this. We have projections, and we have very good ones. But in addition to that, what we have here is that Americans are generally out of sync with the expected total health care in retirement. In fact, according to research, on average, Americans estimate a couple retiring this year will spend just $41,000 on health care expenses in retirement. Now, this, of course, is wildly wrong. Unless those persons are merely calculating Medicare premium. Or what I should say, are not calculating Medicare premium, but that's the out-of-pocket expenses. Right? Because this math has to be wrong. Right? Because $170 right now, let's just round down to 170 times 12. Right? 100 is 17 plus 3 for $2,000 per person. Okay, so $2,000 per person for Part B alone. So that, to me, isn't in here. I think that this is probably the fact that they've already taken it into account netting for Social Security. And so that $41,000 on top of Part B. Then it's closer. And if that is not how it is, and this is the very, very unfortunate thing about this press release, right, is too vague regarding exactly how they came up with these numbers. And this is what I don't love about this annual press release, which is that it simply doesn't tell you enough about how they arrived at the numbers for me to report and evaluate for you exactly what this is. And instead, all we have is this, alarming number of $315,000. But I thought to comment here because this is a report that gets a lot of press, widely reported on, as kind of like a soundbite to say, look out, the sky is falling. I don't think that is the case. That said, that still requires Medicare planning as the cornerstone of retirement planning, no question. Nothing's changed there. Part of the reason for that understanding how this stuff actually works, is that we are still nevertheless affected by the federal government. And you can see it here, Washington Post yesterday. So try to bring stuff on a timely basis. Washington Post, outlook for Medicare and Social Security improved slightly. Trustees warn of trouble over long-term for both entitlement programs. We're not going to settle the debate on whether or not entitlement is the right word here. Please don't infuse, the conversation with your political or philosophical, beliefs. This is not that channel. Really not. We're not going to settle our differences here. I promise you that. We can't agree on the city dog catcher. Okay, so here is that the financial outlook has improved due to stronger and faster economic recovery. Face insolvency, fine Social Security trust, benefits until 2035. Now, that doesn't mean that even this, even this is not about, the Social Security system going broke, right? That is not what this would say. This is saying, look, at these levels, that's how long it lasts. There are a number of different ways that tweaks could be made from that point. And by the way, I'm not on the boat that says these programs are going to go bust and then everyone is going to have nothing. That, these are legislative matters. And the fact is, if you want to unelect yourself real quick, just say, okay, cut off Social Security or take away Medicare. You'll be out of your office, right quick. And so for that reason, just the practical reality is I'm not in that camp of alarmism. Alarmism is probably not a word. Anyway, and you can just see that here, and on we go. It's dangerous. And now all of a sudden we're going to have a bunch of different other politicians, special interest groups, think tanks, taking facts, bending to their own beliefs to try to convince you. And I'm simply, so on one hand, what they're saying is, I'm sure accurate, right? This is known. This is known. This is just your common sense. And this is kind of why I've created this channel, outside of Maximize Your Medicare, which would be, kind of too much towards a very specific niche of a big niche, 63 million. But this is just more about the way that you're receiving noise, receiving information in our day and age. Yeah, we've got huge government deficits, right? And we know this. We have huge borrowing. Part of the reason that, and then the blowback of that is not well understood. I mean, I think that is fairly clear, which is part of the connection point to interest rates, borrowing, and financial markets, financial planning. We're coming up to those. We'll be done within 45 minutes. So that's it for the big headlines, which is, we've had this Fidelity report. We've got a new update here on the Medicare trust system as a whole. And now we get deep into the weeds in a very obscure, maybe obscure only to me. National Law Journal is talking about a particular change to the way that Medicare Advantage out-of-pocket maximum is calculated. And in here is a pretty complicated article, a good one. It's a good one. Don't get me wrong. It's accurate. From what I can tell, it is accurate. But it has to do with the way that the calculation for the out-of-pocket maximum occurs. The reason this, normally speaking, what happens is that the Medicaid amount isn't counted towards the out-of-pocket maximum. Well, now it will be. And the problem here is that you're going to have these filtering in on the math of the overall policies, and without getting like crazily deep in the weeds. And the reason I'm bringing it up here is the following. Is the reason for this book and to know a lot of the nuances about how it actually works, is the fact that they're going to be, as a result of here, the obvious fiscal and demographic pressure, creating rule changes here. And now you see the ripple effect and what can occur. So due to the fact that we've got such a big deficit and 63 million people on Medicare, 10,000 people a day, which will continue on for the next, better part of a decade. On top of that, what you have as a result of ripple effects and pressures, you're going to see small changes at the fringe. And these fringe changes, and you can see down here what will happen, finalize the proposal, and what you have here is the following. That the plans, of course, the sellers, Medicare Advantage carriers, right? They are not going to like this. This was to be absolutely expected, which is that the way that this calculation would negatively affect the carrier. That it negatively affect the carrier. And as a result, the ripple effect would be that something has to be taken away from the plans, which can be at the extra benefits. And I don't have an answer as far as what the ultimate outcome would be, right? I don't have that answer. We don't know because there are a bunch of different forces, right? On one hand, this would be slightly negative to the carrier. That said, the carrier is under tremendous ongoing pressure. Tremendous ongoing pressure in order to try to get greater market share in a world where there are 63 million. Right? And so what you can end up happening is those persons on Medicare and Medicaid, where the Medicaid persons are part of Medicare Advantage plans, a PPO and HMO, that this is going to be slightly worse for the carrier, which means it's going to leak into the entire population of Medicare Advantage policy owners. These are certain things that you need to understand because deep in the weeds, the maximum out-of-pocket limit may be one of those reasons that you would choose amongst the dozens of plans that exist in your area. And now you have thought, okay, well, 2023 is here, and here are the new plans. No problem, no problem. Yeah, not really, not exactly right. Which is that the plans could be under pressure for other reasons that you don't know. And you'd be blindsided if you had no idea about all the different moving parts. That doesn't mean that I'm suggesting, okay, well, everyone needs to read National Law Review. It's a complicated article. I'm here to try to get to the common sense application as it affects you, possible Medicare Advantage policy owner, possible client. We are checking these plans, and there are more reasons that you'll want to be checking every year. This is the financial setup at the moment. For persons, again, there's a reason for all the information on the left here in text, not financial advice. That said, what you're hearing from me is an explanation on the way that markets establish prices. Okay. And I've used the idea of auction theory. And by auction, and I had this, Winnie the Pooh coffee mug. And the point of markets is to establish the clearing price for my Winnie the Pooh mug. And it's kind of a contorted one, right? Because it's not as, I'm just showing you one mug as if that's the only mug. No, let's just say, there are, thousands of Winnie the Pooh mugs. The point is market mechanism is there to establish the clearing price. How many buyers or sellers at what price, period. Okay, this is, that's live there. That's actually, you can see it. Investing.com is a free website, so you can see it. And this is the S&P 500 showing on your screen. In the past, part of the insight here is the fact that while lots of people like to talk about earnings per share, Google's going to make tons of money, Kohl's M&A is, looks all screwed up, et cetera, et cetera. The fact of the matter is that an entire set of persons are looking at markets to figure out as along the lines that I first explained, which is let's just find the market clearing price and see where participants are behaving and at what prices. And as a result of that, I have in the past shown this with this type of diagram where you could see quite a move, right? In other words, we are no better today than April 1 year ago. If you had $100 a year ago, you've got that same 100 today. Despite an incredible move, you can see the high here, the high of being, and this is the S&P 500, 4,800. We're down 700 out of 4,800 from the high, which was literally in the first week of this year. We've been nothing but basically straight down with a that's not to say by straight down, I mean if you put the money in a coffee can. That said, you've had some pretty big roller coaster moves, and you can see it by the height of these bars. Right? The height of those bars, you can see this red bar here. The height of the bar gives you an idea. That's an intra-week travel. So we've had these small little bars. Well, those small little bars have been replaced by big bars. And you can see 1, 2, 3, 4, 5, 6, 7. 7 weeks in a row down. Just to be broken this past week. If we look at these time frames, and you can see as a result what I've been telling to persons on the Substack, the newsletter, and prior videos. Which is what you're doing in trying to establish the clearing price for my Winnie the Pooh mug, that we have seen some congestion in this area here, right? And I'm taking all sorts of shortcuts, so if you're an actual screen jockey, you're going to be like, point out all sorts of shortcuts that I've taken. But basically what we've had here is this congestion zone here. And then after resolved, oops, Winnie the Pooh's coffee mug's not worth $4,500. The next spot that people were debating is the $4,100. And here you have it again. Now, if you back up even further, you'll see how far this little wick tested down, all the way down to 3,800, which is not coincidentally the top end of this range here, where another set of big debates was going on. And now you can understand. You've got a house. It's worth $150,000. What's worth mean? Who even knows, right? Whether or not what the house is actually worth. Well, if 5 people line up and are willing to pay $175,000 for your house, guess what? Your house is not worth $150,000. It's worth more than $175,000, right? Because those $175,000 have said, hey, I'm interested in paying $175,000. And in the same, it's funny that people would logically know exactly what I've just said. You've oversimplified, the housing market, or the way that the price of houses get established. Well, yeah, I know that I've done that, but my point is the same mechanism exists. And in that same mechanism, it is what ends up happening is, okay, we agree it's not worth this. Now that we're debating around here, where was that basis? The basis for that disagreement is right around here. And you can see it goes all the way back to February of 2021. And if resolved lower, we have to keep looking backwards. And you'll see, not coincidentally, that the people that might say, I'm bearish the market, they're looking down here at 3,400. Somewhere in here, right? And not coincidentally a congestion zone. I'm not saying that's, where we are going, right? Because still ultimately what? Yeah, still ultimately, oops. That's the wrong image. That's the right image. Let's see if we can pull it up here. We're still no good at this, aren't we? We're still no good at it. Let's just see. Yeah. First, let's turn the camera on. First, let's turn the camera on. There we go. What ends up happening is you have a bunch of different layers and things like that, and then that's basically what this thing is. That's the wrong image. This is the right image. So not surprisingly to anybody, right? We are still right here. And I do need to point out one thing about this. This is not these individual spots, these branches on this lattice, right? These different paths. This isn't really thought in price or dollar terms. It is really based on percentage terms, right? So plus 1%, minus 1%. Plus 25%, minus 25%. That's the point here. It's not a dollar, right? Because that doesn't scale it correctly. It's an important point. It's a subtle point, but it's an important one, right? Which means that over here, as you can see, right? If you go back to, here, the issue is this stuff is told to you on price. This, however, tells you more along the line of the way that lattice diagram works. Okay. And as a result, that's what you have. And here you can see it today. That said, still governed by the idea. Still governed. As always governed, to be candid with you, right? As always governed by here. You're never getting away from this. I'm never going away from this, right? In the sense that this is still the framework ultimately. Now, at certain very short periods, and in a prior video, I showed you a day trader, right? I showed you a day trader on what they're doing in actually trading this S&P 500 futures contract in Chicago throughout the day. That's just a matter of time scale. And then one of the reasons that I like this graph is because this diagram is because you can see horizontally, it's not stating a time frame. I didn't say it was a second. To some persons, to the day trader, this is, 30 seconds, a minute. To different people, depending on their planning horizon, the amount of runway, right? These time nodes are different. These time frames are different as you move to the right. You're 35 years old. Okay, maybe you're thinking about these time frames in 3-year time frames, 5-year. You're 75 years old. We're not thinking about things in 5-year time frames. We're not. We shouldn't be, right? Because the number of time nodes you have is fewer, unless you have discovered, the fountain of youth. But that's actually what I like about the diagram, because the diagram is just telling you, and it tells you what has gone on now as well. That, I don't have the stretching mechanism. I'd be able to do that using other tools. But you can see what has happened is that you can see that the width of this triangle, the triangle that you see there on your diagram, that the width of this thing is now just much, much wider. It was narrow. It's now much, much wider. And this has been my point, right? Which is inflation takes no prisoners. Is that the reason that it's this much wider is because interest rates have created this situation which is wildly misunderstood and underestimated. The show hasn't started yet, by the way. Quantitative tightening begins actually on June 15th. Because it's the first time that their holdings are going to mature at the Federal Reserve, and they're not going to take the proceeds to buy other securities in the open market. They're just going to sit with the cash. They're not going to take that cash and reinvest it in other U.S. government securities or U.S. mortgage-backed securities. And this is what is basically the quantitative tightening that you'll hear. The fact of the matter is, we don't know yet. We don't know its effect here. We don't know its effect here. That show is yet to be seen. One other thing here, as based on what I've just said over the last 15 minutes, and what I've just most to subscribers to the Substack, this is no secret, right? Stocks for show, bonds for dough. Bonds for dough, nobody cares about stocks. Not surprisingly. So, yeah, this graph doesn't come out well here because it's not continuous enough. Anyway, not surprisingly, what have you had? You've had remarkably multiple, this is not a good time frame here. Here's a good one. We've had this period of days here where rates really haven't moved around too much, and if anything have gone lower, allowing other risky markets to grind higher. Right? And how do you get to there? Very, very simply, right? Which is obviously here, right? This is the valuation metric. This is a valuation framework for anything, including your house, right? Which is its interest rates went lower, so that if everything else were to stay the same, then the NPV, which is the price, goes higher. What I've been saying here is that this thing has been so unstable that what has ended up happening is this triangle gets wider, flatter, meaning that you've had bigger bars up and down in financial markets as people not yet settling on the actual clearing price for Winnie the Pooh's mug. And even with a notable increase in prices in risky assets over the past couple of days, that still hasn't fixed everything by any means. It has certainly gotten better. I don't think there's any doubt about that, but you can still see it here. This is Vanguard's targeted retirement fund. And I'm always use best of class, so I'll show you BlackRock in a moment. That you're still minus 11.25% year to date. So if you had $100 if you had $100 on January 1, you've got $89 now. And oh yeah, by the way, if you think that I'm randomly making this up, the same target date 2040 as the prior page, you can see another BlackRock, again the best of class, still the best of class, no question. We're not debating that, right? We're not debating whether or not this is the highly qualified. No, we're not. That's still, and you can see how close they are. 11.6% here. 11.28% here. 0.12%. Right? Not on $100, right? That is 12 cents. On $100, that's a 12-cent difference. Meaning that there's only one method by which they're creating these portfolios. And it's not guesswork, right? This is not guesswork, meaning the creation of the models isn't guess. They know how to create the model. The outcome can be random because of why? Because financial markets are subject to randomness. That's the point of the lattice. And now slowly, to some people, to the advanced, to the math jockeys out there, they've understood this. They've already, candidly speaking, they've already changed channels, but they already understand the dots that I'm trying to help connect for you, right? Which is, and this is the whole point of Jay's Corner, which is that you've been led to believe, oh, well, stocks are higher in the long run, and here are my studies of 300-year cycles. Okay, well, my lifespan's not 300 years, right? And in fact, the productive window by which you're going to make and earn and save and invest, this is actually much tighter time frames than the ones that are being reported to you. So the idea that, and oh yeah, by the way, they look different than concentrating on this, right? What you have on in the popular press is talk about C, and that is from a prior video, happy talk, right? Yeah, when R is this stable, you can divert your attention to C all you want, but that's not our situation. And this is a situation we've not seen in decades, and actually is different in nature than the housing crisis. The housing crisis, I could simply throw dollars and fix it, right? And that is what Fed Chairman Bernanke did, right? There was a banking system, there's a systematic banking problem. He could fix it. How? He backstopped money market mutual funds to guarantee the liquidity of short-term debt. He bailed out AIG after seeing how pear-shaped it went when he let Lehman go. And he wasn't alone. Don't get me wrong. Right? Even they underestimated the systematic financial system risk. They, however, had a clear fix, which is to put a Band-Aid on it. This one here under supply is different. We don't have the same flexibilities. The Federal Reserve doesn't have the same flexibilities it did. Could I be proven wrong? Sure. Of course I could be. But even they are saying so, that they're behind. They've admitted so. Let's continue here. And it's the last few moments here, which is that, can I change? Can I change? Well, the good thing here, and we'll go to the Substack, and just to go here. This is the Substack itself, and you can see here where I've pointed out, that the denominator is stable, right? And there it was, allowing happy talk here. The good thing about having the newsletter is, you've got a timestamp that I'm not going to be changing stories. I'm not going to be, the facts underlying are going to change. That's the random part. How to look at it, however, isn't going to change, right? Because I didn't make this up over here. And that's my point. There's no way we made up these models or the way that the methodology to create something that the results are 0.12% away from each other after 5 months of every day calculating. You know better than that. Podcast, etc., etc. But you can see here that, again, that we are nowhere close to the end of volatility. Not even close. That's my view, because of the fact that interest rates just cannot, and you can see how, but nevertheless, here's where we are. So I've hemmed and hawed for a few minutes, but now here we are. So what date was this? I don't think it does say it. Does it say a date? Here we go. May 20. Just 10 days ago. On May 9th, close of May 19th, minus 15.52. This is quite a move. Right? 4% is not small. Now, I'm not saying that, are you going back up to, year to date at positive? I just don't, you just take a look here. What does this tell you? Does this look like the path can continue on where you continue here to make up all 11%? And it's be tough. Because that would require R here to either be way lower, that would do it, or stable and unknown to be stable. Instead, we have quite the opposite of that, right? I've not said a single thing about whether or not I think Apple has demand problems. Right? Not a single word about it. Because that is the random fact here, which is in here. And are there scenarios where then, however, that you then make back on this diagram all the way to get back 11%? I think that's pretty tough as they currently stand. Right? We don't have the pinnings here by which to create situations where this then all of a sudden says, oh, okay, now we are much narrower in scope And then also where the average has moved higher as a result of the fact that interest rates have moved lower. You need them both from this point in order to have meaningful recoveries all the way up to anywhere near January 1st of this year. That's the lay of the land. Could an external shock change all of that? Yes. In theory, yes, that is the case, right? Whether or not, however, we'll be anywhere here. Yeah, that could happen, and I'll show you where it could happen, right? And you'll see this out in the world, which is that, yeah, you'll see that the Federal Reserve could possibly take action. And where are they calling for action to be occurring? Yeah, the idea that they're not watching the stock market is, bogus. Where are they looking at? Oh, what I was saying before, 3,400. Then maybe here. Well, 3,400 from here is 700 out of 40, 4,100 lower. Right? That's another 15, 16% from here. That would make us down, something like, from 48 to 38. To 34, I'm sorry. If you said it from here, that would mean 14 out of 48 lower, which is basically 30% loss year to date. On the S&P, which mean much, much worse for the NASDAQ. The wind up here for the next 10 minutes is for the following. Is that because of if you've understood where I'm going, which is to say, look, we are here as it is. You are here at the tip of the arrow. That means the same idea is that it's not too late to adjust. Whatever that adjustment is, with no judgment about how you got to this spot, right? I'm talking to myself. I'm not talking to your particular situation, right? With saying absolutely nothing about how you got here. The idea that, okay, well, I'm just going to stick to it. That could be okay as long as you understand that nothing said that we can't keep going down. As long as you can understand that if it goes down and it's accompanied by the fact that you've got all of a sudden an unintended, unexpected, cost as defined by, things like, this. Because it's not for me that this could happen. This can happen as a result of randomness. My point is, as you travel down here, because you're a buy and hold forever person, which is a way to do it, that in doing so, if at that time you then have one of the costs as shown here on this, right, and now you incur an out-of-pocket cost, that's the same thing as selling at the low. So either you've got this cash barrier, right, lots of spare cash to pay for this, to buy you time to go and wait for other scenarios. That's certainly one way. That's not a bad way, by the way. Right? Meaning that a lot of other videos here on Jay's Corner that I've moved from the Maximize Your Medicare channel to Jay's Corner, intentionally so. Why? The annuity video, the life insurance, the retirement miracle video. Those are different components of building these buffers so that you can take this wider volatility here. A triangle where the high to low is higher. A time where these bars are much bigger. And in that, that's what kind of brings you to how we, where those bars are much bigger. And, you know, I'll get better at this as time goes on. But you can see now the bars are bigger. Very clear. Another way of saying, it's another way of saying is the triangle is now wider. That's all. That's all it is. Nevertheless, you're still here at the tip of this red arrow. And your takeaway here is that now we've gotten back 4%. We'll give some of it back here today because these are not live. This is not a live price, right? So in other words, it is now 11 minus 11.16. And maybe your portfolio is much better. Maybe it's much worse. It could be much worse, by the way, if you've bought Peloton or thought that, you know, Netflix, Peloton, PayPal, these individual names, if you don't have an edge, good luck to you. You need to have something pretty specific reason for you to choose individual line items. If we go here and you've recovered 4%, right? It's still a big move. Minus more than 4.25% better today than you were even 10 days ago. So the reason I'm setting this on a Friday is that people should take the weekend to see what to adjust, meaning to rethink, are my pieces in place? Because that opportunity is here, and this is going to be my last point, is you will see, as a result of, and we'll see it, let's see if we can actually bring up the website. I want to say one of them, let's just take a look at this one. No, this is not the one I wanted. Blah, blah, blah. Advisor World. Media, highest companies. No, that's not what I want to do. I think it's annuity.org. No. My point here is that, I want to say this. So, what you can do, and let's just say you're January 15, 1960. Right, and let's just leave it in here. No, let's just have it, my spouse. And let's just make it the exact same date of birth. Okay. I'll be using it for personal savings, so you can use it from qualified or non-qualified. That's fine. Blah, 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 blah. Yep. And you will have numbers here. These numbers are higher. These numbers will be higher. Meaning, because when interest rates go higher, as they notably have gone higher, right here it is.